the lovely topic of an S-curve of the development facility, which is probably the most important part because it's basically the cost of finance while you're delivering the project. The bank fund the first part, which is the full duration of the project, which is the purchase finance. That goes in the day that you buy it and comes out the day that you pay that last flat down or whatever it may be, or refinance. Whereas the development facility is quite a convoluted process to estimate what that's going to cost. And that part is called financial S-curve. Not even really sure why it's called an S-curve. As you can see, my artistic flair came into action this afternoon. Tom and my team wanted to understand how our finance works on our spreadsheet. So I did a recorded Loom call so anyone in the company can watch it in the future. But I basically went top to toe about everything. So debt, leveraging, the equity piece coming in, how we charge finance to a project. When we were talking through it, it's very straightforward. I was like, the bank take like 70% of the total capital stack. The investment, whether it's with us or an investor, is the rest. The way it's drawn down is like 60-70% on purchase. The investor money comes in and then we draw down the bank facility thereafter. The bank charge in and out fees as well as a rolling annualized fee. The investment can either be obviously a coupon or it could be a joint venture. And we then got on to the lovely topic of an S-curve of the development facility, which is probably the most important part for Tom because it's basically the cost of finance while you're delivering the project. The bank fund the first part, which is the full duration of the project, which is the purchase finance. That goes in the day that you buy it and comes out the day that you pay that last flat down or whatever it may be, or refinance. Whereas the development facility is quite a convoluted process to estimate what that's going to cost. And that part is called the S-curve. I've worked with and or met brokers that don't even understand this, and it is really straightforward. And that's not actually because it's really, really complicated. It's just negligence by understanding detail and asking those questions, because I want to know, because at the end of the day, if the cost of finance costs us something, we want to know exactly what that's going to cost us. The bottom axis is the length of the project between start of build and exit, so refinance or sale of the last unit, and the upright column is how much money you've borrowed. And what you tend to do is you borrow chunks of funds. This one is showing 4 chunks of funds that you've borrowed up. That might be 100, 200, 300 or 50k if it's a HMO refurb. In the drawdown process, where you've proven that you've done that amount of work, you've got the monitoring surveyor to site, they've produced their report, bank have signed it off, and then you draw down the funds. So in this particular example, we've borrowed 4 chunks of money. It doesn't really matter what it is, up to 100% of the build costs. And that's what we've borrowed. Where the complexity comes is we've now got to sell 10 apartments that incrementally pay that development debt and the original purchase debt down, because the loan to value has stayed consistent across the two. And the reason that the bank pay down in chunks is to stay on the more cautious side of the loan to value or loan to gross development value at that point, or even loan to cost. And then the chunks that get paid down, normally banks are happy to forego that you take profit on sales, which normally pay back the investor, or if it's just yourself, but their loan to value maintains the same. So if they're at 70% loan to GDV, they will let you release maybe 30 or 20% of that as you go through the sales. So as you sell units, you're paying them down in chunks. Obviously, a refinance stays flatter for longer and then pay it all down in one hit.
If you get value from these videos, imagine what we could do for your business with more one-to-one coaching. Now, we've spent over £100,000 on training, business coaching, non-exec directors, and we love sharing that information with our mentees. Click one of the links in the description to find out more. Back to the video.
Now, to calculate this is an absolute logistical nightmare. The reason being, you don't know the day you're drawing down to accrue the interest for that. You don't know how long the delivery is going to take, because it's to some degree an estimated period of time frame. You don't know how quickly the sales are going to fall through. You might have a longer period of marketing and then sell 3 in 1 week, and you have to draw an assumption. And the way that I like to explain this, and how I explained it to Tom, is if this was a solid bit of something and you melted it down, it would fill that graph linear halfway across the curve, which is basically why we take an estimate of 50% of the finance costs. So it's basically showing that the half of the finance cost is where it's at. So what we do is we take the finance rate. So let's say your bank are charging 12% per annum. This is an example. You typically halve that, so 6% for the total build costs. And then we actually add a 1% contingency just to be on the safe side. That runs for the duration of the build and sales. So let's say you started building and you're selling in 12 months time, but the whole project takes 18, so 6 months getting detailed design and bits and bobs like that. But your build and sales is 12 months. So let's say 6 months build, 6 months sales. You will take the total amount you're borrowing, like 300k and build, for an example, times it by 6%, add the contingency on, so times it by 7%, divide it by how many months you've done it, and then get your monthly rate of that cost. So if it's taken 12 months, that'll be 7% of that total 300 grand that it's cost you. So that adds on to your purchase finance and all the other finance costs that are in there. I hope I explained that okay. We do have a finance calculating comparison sheet if anyone would like that. Comment finance spreadsheet in the comment section.
If you got value from this video, make sure you click the subscribe button down below and ring the notification bell, because we release one video at least every week, so you'll be the first to get notified. See you on the next one.